Your next lesson on trading discipline is going to be something called a nibble trade. Now, this is a little trading tactic that you can use quite a lot of the time actually, and we'll explain. You're looking to buy a dip in a share price that is rising. You have identified on a chart a horizontal buy line or support line, and directly below it is another horizontal buy line. Now, the price is just above, so you are expecting the price to come down and hit this first buy line. Now, there are a few outcomes that could transpire. The price could hit your first buy line and bounce and go higher. The price could break below your buy line, hit the second buy line and then bounce higher. Or what could happen is the price could come down, break through the first buy line, break through the second buy line and take out any stop losses in that area, which will cause more downwards price movement. So what is the best way to tackle this? Now, what would you do? Some people would say ignore the first buy line and just go for the second, but you have a big risk of missing a good trade. If the price comes down, hits here and bounces up and makes new highs, but you had your order here on the second buy line, you're going to miss the trade. If you buy on the first buy line and have your stop loss below the second buy line, it may break through the second buy line and hit your stop loss. That's quite a chunky loss that you'd make. So we have what we said is a nibble trade, and how that will work is the price will come down to the first buy line. You will buy, let's say, 25% of your target holding in these shares. If the price then hits this buy line, you buy, it goes higher, you make a small profit, so you do not miss the trade. If then the price you buy on the first buy line, it breaks down and hits a second buy line, you can then buy the remainder of your 75% target position, and if it breaks down and hits your stop loss, the biggest bit of your position is right by the stop loss, so you're not making a huge loss. Best case scenario is you buy 25%, it falls down, hits the second buy line, you buy the remainder of your target position and then it goes higher. This strategy is the best thing that you can do, because there's a risk versus reward. Risk of missing the trade in the first place, risk of making a big loss. This is sort of in between. It eliminates the risk of missing the trade, and if you do make a loss, it's going to be a lot lower, and it's positioned you to make the biggest possible reward through whatever outcome happens, because you don't know what line is going to hold, if any.